Yo. Okay, alrighty. So I was looking at the SP 500 on a 1 hour chart, right? And I was looking at the sort of slow stochastic. Although this one I've got the setting changed to 1033 instead of 1433, which is the standard setting. So I've changed it. It's a bit faster. I'll show you the difference, right? So that's 1433, and the indicator looks like that, right? So you've got a low around this area here, and then you've got a low around this area here, and a low around this area here, and then here as well, right? And then currently where we are now, it's almost hitting a low, right? So if I change that then to a 10, we still have a low in the same areas, except now we almost have one over here. There's a bit of a dip here. This low is a bit more pronounced. There's like more time that the oscillator spends below this line, and here it's already below 20, right? So 20 is the line I'm talking about. So just to go back, 14 doesn't quite spend as much time. There's like that other one's got two deep dips. This one is not so bad, right? So it's a very, very small difference. So you're just using 10 periods instead of 14 to calculate the average, right? So it's a bit faster in the sense that it gets to the opposite end a lot easier and quicker. So, all right, okay. So what I was looking at is this could be a like a wedge, right? Wait. Right, so that could be like a falling wedge from an freshly oversold sort of position on basically a if we count the resistance levels here and the support levels, we're going to find that this is a area of support and or resistance that is valid. That is valid too. That is valid. Sorry, I was just going, this is a bit tedious at times, but basically I'm identifying points of support and resistance according to the Mark or Williams method. Bang. Okay, so that's like a whole, almost said a really bad swear word, whole lot of lines, right? But those are like your support resistance areas, okay? So these could be levels that you could be trading off of. So okay, there's a lot of traffic, so we'll move the ones that are somewhat irrelevant. So I'll take out the resistance, the support levels, and I'll just leave the resistance levels from a bull market perspective. Okay, so if you're going up, I'm taking away support and I'm only leaving what was resistance on the way up. Okay, so it gets here, boom, there's resistance in this area here, and then poof, it breaks through, hits the next level, sort of breaks through, now it's come down, that looks like it was a bit of a level, try to break through, it's come down again. So what we want to know is in almost every step here, it hasn't really gone below any of our prior resistance levels, right? So that resistance is naturally the support. So we're basically taking a long here, or there's a potential long entry, right? Sorry, I'm getting messages. Anyway, so this could be a nice area for a long position, right? If this wedge breaks out, but we have to be aware of like the larger picture here. So my argument is that if we look, okay, here there was a bit of a breakaway. So indices don't gap, but this is index future derivative. It's a CFD on the index future. So it's left a gap. I largely say you can ignore it, but you can count it if you want. If you will, then that's an exploding gap pivot. Boom. Well, it actually closes the gap. No, it doesn't. Anyway, so the last time that we had a move down on the stochastic below the 20, a couple of things happened. If we start here, that move down and a buy was a nice time to get in. If you had to be patient, but you got this whole trend, right? And then on your first dip below, it takes you out there. I mean, that's fantastic, right? Here it dips below again, so if you buy when it dips below, which is basically now, right? So if you wait a few, you'll be able to rather buy when it goes back up, right? Anyway, so if you buy now, you're buying like either here into that, or you're buying here, because then it goes up, boop, gives you another buy signal, so you buy some more, gives you another one, you buy some more, gives you another one, you buy some more. If you did all of that and you catch this fucking trade, that is a magnificent trade, and this is your sell, right? So both times here, that was a long and that was the sell, followed by this consolidation area, followed by this, boom. So the question is this trade where you just kind of get it, have to be a little patient, bang, you get a wonderful trend? Or is this entry this trade where you buy and you got to add and add and add your way out of trouble until eventually you come down to what was a like a resistance level before? So I don't know which one of those two it is, but that's kind of my view on a 1 hour chart on the SP500. What you could do is you could basically just build a plan around around like both scenarios, right? Plan out the trade on both scenarios, see how much, if you were to consider that you wanted your full positions only scaling in after like 4 entries, how does that impact your risk management? You know, how big is this position? What does it cost you in all sorts of transaction values and stuff to be able to put on? How much interest are you going to pay if it takes out a month and you buy like once a week or whatever? Well, I guess this isn't quite that time frame. These are a couple of days, because this is an hourly. Well, this is now a 4 hour chart, but on this time frame, it's a 1 hour chart actually. So yeah, if you bought let's go here. If you bought there, how long are you in this trade? From the 4th to the 15th. So that's like, okay, it's 2 weeks. And you would have added 4 times in that. So calculate that as worst case scenario, the full exposure for the full, 2-3 weeks. Plus what your 4 entries would cost you, what an exit would cost you, where you would stop. So it's important to work the costs into the equation, because you're trying to limit your loss on capital, right? So what you first have to do is work out exactly how much you're going to lose in all the costs. And then from there, say, over and above that, how much of my capital am I willing to lose? And then you work it out that way, right? So you say, like, I'm willing to lose $2,000 per trade. Putting all these trades is going to cost me 50 Rand a shot. So it's $200 to get in. Provided I take one exit on the out, it's another, $50. Well, depending on the size of the position, because it might be more, so it might be $200 depending on how big you're trading. But just work out the exact cost, right? So yeah, anyway, it's very easy. Exposure times brokerage rate, and or $50, whichever is bigger. So okay, anyway, yeah, so you work out all that stuff, and you say, okay, it comes to 1,000 Rand. and I'm willing to lose 5,000 Rand every time I get it wrong. So I've got to place my stop loss where the trade itself lost 4 grand, because I need to it's going to cost me, a transaction fee to get in and out, irrespective of what price I get out, I'm still going to pay, right? So that's like a sunk cost. So it's better to plan for that in advance. But then you could plan out, like, okay, if I buy here, if I get it right, then at least I have exposure if this is the case, right? And what you could do is you could then say that you would add to the position every time the stochastic breaks there, at the top. So every time it sort of breaks back above, you buy, breaks back above, you buy, until you get a break below, then you sell. So that even if you have only a small entry, you then build into a bigger position as the trade works out, right? Or you just wait until you have confirmation that that this isn't happening, which is risky. So you would have to wait for this thing basically to turn back up, and then just count your lucky stars that you don't get stopped out, because So the better way to do this trade, instead of saying like, okay, cool, I'm going to risk 2% of my portfolio on this one small tiny little wedge formation that, how long have we got? 57 minutes. All right, fine. Depending on where this candle closes, hey, that might be it, right? It might be your signal to go long. So instead of just trading 2% on this trade, saying, oh, your stop loss has got to be below this consolidation extreme or whatever, which just happens to coincide with the support level, so you overcompensate and you put it there, 3007, okay, is your stop. So instead of risking 2% of your portfolio on that trade, rather risk 2% on your portfolio on like this trade, where you're compensating for what if this is the case and you've got to add to this trade 4 times and you want to take 50,000 Rand exposure to this trade. Rather take just 12,500 now, if that makes sense, because you're just limiting risk a whole lot more. And then if you have this situation where it comes down and it gives you multiple sort of breaks below, every time it breaks below, you buy some more, right? Or cuts back up or whatever, and you can mess around with where you would get the better entry there, all you like. To me, it doesn't really matter. Like, I'll buy it if it is below, and there's something like a valid signal, right? So yeah, that's kind of SP 500. This was an unplanned video. I hope it works. I hope you guys like it. I'm gonna I'll stick it on YouTube, but I don't think I'll make it public now.